Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, finance presenter and economist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café. Sorry, James, I jumped in there.
Okay. I was trying to pace myself to your timing to get that musicality going.
That's impossible, mate. Now you've usually written a column by now. So what have you gone with this morning?
Well, there's a really interesting AI war building up. Well, it's probably not a war, but that sounds better. In the last few days, Google has had sort of two victories, one over OpenAI and one over NVIDIA. So the one over OpenAI, Google's got a ChatGPT model or a ChatGPT rival called Gemini. And the latest versions come out. Everyone's very excited about it. Apparently, it's does great things. It's a leap forward, all that sort of stuff. So that's a win for Google over OpenAI.
What does it do? What does it do differently? Do you know?
Well, look, I'm no expert, Alan, as you well can imagine. But Mark Benioff, who's the CEO of Salesforce, a big US tech company, he tweeted that its images are great. It's a leap forward. Everything is sharper and faster. Reasoning speed, images, videos. It feels like the world's changed. The leap is insane. So look, it's probably a bit of tech gushing, but so that's had some interesting reactions though, and I think this is the sort of like a bit of the butterfly flaps its wings in the Amazon. So. You might not think of this, but Google shares went up. That's okay. But the shares in a Japanese company called SoftBank, have fallen 20% in 2 days. Now, why? Well, a couple of weeks ago, they sold their stake in NVIDIA so they could concentrate on their other AI bets led by OpenAI, who they've got a big deal with. So now people are suddenly betting, hang on, SoftBank's backed the wrong horse. Because ChatGPT is going to lose market share to Gemini, we're selling SoftBank shares down 20% in 2 sessions. It's an incredible move. I mean, some of these moves are just crazy.
Wow.
We're also seeing a few other things. NVIDIA's shares, despite that incredible result they did release last week, they're off 15%.
What, in a week?
No, 15% since the start of November, essentially.
Right. Yeah.
So, I mean, that's still a substantial move.
Yeah.
We're seeing the credit default swaps. So this is the cost of insuring the bonds of against the default in the bonds of Oracle, which again has done another big deal with OpenAI. Those are shooting through the roof. And then Google shares themselves. Now, this has sort of snuck up on me. It's not that long ago, Alan, that people were saying, oh, Google, they're stuffed because everyone's just going to chuck no one's going to use Google to search the internet anymore. They'll just chuck their questions into ChatGPT or Gemini or whatever, and all that search revenue that Google has been built on is going to disappear. Well, hang on. Their stock is up 85% in 6 months, Google. And
it's up the most of all of the big tech companies. It's done the best.
In fact, it's accounted for the biggest... The gains on the S&P 500, Alphabet is the biggest driver of those gains year to date. So all this says to me is, losers can become winners with a couple of right decisions, and B, there's some doubt in the AI space now, but people are acting on it. There's 3 or 4 short AI trades that are becoming increasingly popular. Sell NVIDIA, sell SoftBank, buy credit default swaps in Oracle. There's another one, a private credit operator called Blue Owl, which most people probably haven't heard of. Its stock's down 45% since the start of the year. It's one of the biggest debt providers to Meta platforms. So there's all these different permutations.
It feels like investors are thrashing about, not quite knowing what to do.
They are. I think that's exactly right. And then last night, on Tuesday night, we had NVIDIA come out and, respond to this. Amazingly, I mean, we never see this, but NVIDIA put out a tweet. We're delighted by Google's success. They've made great advances in AI, and we continue to supply Google. NVIDIA is a generation ahead of the industry, though. It's the only platform that runs every AI model. Now, okay, maybe Jensen Huang's mob is just stating facts, but that is not the actions of a company totally relaxed about the narrative in AI world at the moment. Yeah. Very strange.
Yeah, well, it feels a bit like end of days, really.
Oh well, look, it's not end of days. I just think this stuff is. I mean, our mate from Macquarie, Victor Schvetz, he's got this theory that because there's so much capital in the markets and because of how flighty markets are, things can change in like very quickly. One or two bad decisions or good decisions lead a stock to re-rate, and I think that's what we're seeing. Once again, our old mate Victor's right.
Speaking of bad decisions, let's move on to DroneShield.
Yes.
You concluded a column the other day by saying that DroneShield needs to grow up and fast.
Oh.
So, yeah, I mean, obviously they made some bad decisions by Oleg Vornik, the CEO, and a couple of other directors selling all their shares.
Yeah.
And in doing so, selling a lot of them just after a mistaken announcement was made, which caused the share price to go up briefly.
Yeah.
So that's all been terrible for them.
Well, my point, Alan, is, that's poor governance. That they should have been on top of that. But then maybe we should have seen this coming. I mean, the DroneShield board has 5 members on it, and I think 2 of them joined last October. So before that, it was 3 people. Now, that is not... this company's in the ASX 200. When it was, a few weeks ago, it was worth almost $6 billion, worth more than Treasury Wine Estates, AMP, Lend-Lease. You can rattle off any number of big-name companies. Do you think any of them it'd be appropriate for them to have 3 directors or even 5 directors as they do now?
So by grow up, you mean they should have more board? They should have a bigger board.
Well, not just a bigger board, but better governance. How many times, Alan, in the 2025 financial year, do you reckon DroneShield's Risk and Audit Committee met?
I don't know. Do you?
I know, yeah. But how many times do you think on an ASX 200 board the Risk and Audit Committee would meet? Once a month? 4 or 5 times a year?
Preferably once a month, but maybe once a quarter would do.
Yeah, well, they met once.
Yeah, right.
I mean, I think some of these red flags have been out there and perhaps we should have taken more notice of them. I think that's the sort of stuff where you say, if you want to be a big company, you've got to act like a big company and have governance like a big company. You don't get to... You're on the ASX... You're in the ASX 200. You're playing with other people's money. Act like that matters to you. And I think that's, to me, is, even when you leave aside what's happened in the last few weeks, which is impossible to do and still hasn't been explained by Oleg.
You seem to tell one of your colleagues on the Financial Review that there was some threat to life, that he had to sell. What was that about?
That's apparently the story he's been discussing with investors, that, basically there's 2 parts to this. So the shares he got, his compensation, his remuneration is heavily share-based, and so that's been approved by shareholders. So he feels he is in the right to sell all his shares, convert all his options, and then sell all his shares, because that's a big part of his pay packet. That's what he's owed. And then the other part of it is, yes, that Russia has been targeting defence CEOs, and so basically he deserves as much danger money as he can get. So make of that what you will. Again, he hasn't done any interviews. He hasn't explained why he thought this was a good idea.
So he's spending the money on a bodyguard and
maybe.
I don't know what else.
Maybe, yeah.
Bit of Kevlar armor or something.
Yeah.
Anyway.
Can I ask you a question, Alan?
Yes, you can.
What did you make of the COP30 wash-up? You won't be attending COP34 or whatever it is in Adelaide anymore, but is there anything we can take from this year's session?
Look, the main... nothing came out of COP31. Sorry, COP30 in Brazil. Really nothing. Nothing of any substance came out of it. It was just another kind of talk fest where they didn't really get anywhere. Turkey's going to host next year's. Australia was trying to host it, but basically did a deal that says that Chris Bowen, the Minister for Climate Change and Energy, becomes something called the President for Negotiations between now and COP31. So he is somehow running the negotiations that lead up to the next meeting.
Gotcha.
That's usually the host country that does that, but apparently we've got that, and I don't know what that's going to mean, really. I just think that the whole process has been taken over by fossil fuel companies, really. I mean, most of the last few of these conferences have been held in countries that are big fossil fuel exporters, and the appointment of Chris Bowen as President of Negotiations continues that tradition, because Australia is the third largest fossil fuel exporter in the world, and we're apparently now running the next lot of negotiations.
I get the urgency of having a COP every year, Alan, but do we sort of risk denting the importance of these meetings, or is there just so much to get on with? We do need to have them every year.
Well, yeah. Look, they started in 1995, full of hope, and we're going to do something about this. And we signed 2 years later in '97. Everyone signed the Kyoto Protocols, and it was full of ambition and hope. We're going to stop the world burning, and even in 2015, everyone kind of got together and had another big deal in Paris, where everyone agreed we're going to keep the temperature warming to less than 2 degrees since pre-industrial, and preferably 1.5. And it was all terrific, but nothing's happened really.
Yeah.
It is too hard. I mean, the fundamental problem is that the countries that have got rich from fossil fuels, which include Australia, aren't really prepared to pay the money required to help the countries that are trying to get rich move away from fossil fuels towards renewables. I mean, China's doing it itself. I mean, they are unbelievably active, and spending the most in renewable energy. But it's really not just China; it's other countries that are saying, "You've got to help us. You've got to help us do it. We haven't got the money."
Yeah.
So that's really the basic problem, and also the other problem is that nobody really wants to do what it takes.
Yeah.
To achieve it. So, and just before we move on to questions, we probably should talk about Bendigo and Adelaide Bank, which, talking of governance, we're talking DroneShield's governance. They had a report. They asked Deloitte to investigate one of their branches, and Deloitte's come back and said, actually, no, it's not just one branch; it's everything. Yeah. It's all over the place. So tell us about that.
Well, we don't have too many details, but yes, there was a branch that Bendigo asked Deloitte to have a look at. Suspicious activity related to potential money laundering going back 6 years, which is a bloody long time. Deloitte did the review, and as you said, they found some quote unquote deficiencies, but those deficiencies weren't just about one branch, but about the wider network. Now, Bendigo in some ways has taken an admirable approach to this. Mostly, we've seen banks with money laundering issues wait till they're taken to court by Austrac to fess up to anything. Bendigo's tried to get out in the front foot and say, yes, we've got a problem here and we're disappointed by it, but we're on top of it. We're going to sort it out. But that didn't help the Bendigo share price on Tuesday. I think it was off about 7% in the end, because Bendigo, like all the banks, has got a cost problem. Their costs are rising much faster than their revenue, and when the market hears we've got a money laundering, anti-money laundering problem we need to fix, what they hear is, here's another big pile of money we're not going to need to spend on our systems. This goes back to, there was a fascinating moment in Canberra at these parliamentary hearings last week where Matt Comyn, CEO of Commonwealth Bank, got up and said, basically, the economics of banking are really creaking. There's a hell of a lot more competition from a hell of a lot different places, What we're seeing is costs rising very rapidly. Comyn said 50% of his customers in the retail bank are basically unprofitable, which isn't that surprising, because you'd have a lot of customers who are, in the cost to serve them in remote and regional areas, for example, would be far more expensive than customers in the cities. But I just think it's an interesting way to think about the economics of banking. Lots more competition, costs rising. Yes, the profits look very big, and there's no disputing that. So Matt Common's not going to get any sympathy, and nor will he expect any. But it's just interesting to think about. We think of these banks as impregnable institutions, and they're backed by an implicit government guarantee, so they are. But the environment is changing.
So I wonder whether they're going to respond to this by really going hard on AI, these banks.
They will, but what they probably would like to do is the obvious thing. I mean, 96% of their transactions are digital, and yet they've all agreed to keep their branch networks up and running for political reasons. Like the obvious thing to do would be to get rid of most of the branches, but
Right.
it's not politically palatable. And I think that's what Common was trying to get at. Politicians love to whack banks, and fair enough, but he's trying to say we're not the big impregnable institutions that we might appear to be, or you think we are.
Yeah, well, Paul Graham at Australia Post is already whinging bitterly about how the banks are shoving all this business onto the Australia Post, and not paying them enough for it. So Australia Post is kind of losing money on their banking side of things, and because they've got obviously got branches everywhere, and the banks are starting to using that. Maybe the banks will do a proper deal with Australia Post.
Maybe. I mean, they increased the amount they paid them earlier this year, so I don't know.
That makes sense. I mean, why not? I mean, fair, they might as well.
It makes sense to pay them to pay the Australian Post outlets more, and then be able to close your branches. But they've agreed to these moratoriums on branch closures.
Right.
So that doesn't make a whole lot of sense to me.
Yeah.
Should be probably one or the other, but anyway.
I think you wanted to talk about BHP and Anglo as well. Is that something you want to
look? I mean,
throw in there?
It's just interesting. So BHP last year, they had a big crack at trying to buy Anglo American, which is a South African miner that has, amongst other things, some very tasty copper mines that BHP would dearly love to own. That bid fell over back last year, and BHP's walked away and said, "Oh, we'll be very sensible. We don't need to buy this. Or we've tried, but we're going to stay disciplined." All that stuff that companies say. And then, lo and behold, we find out this week that just as Anglo is about to merge with another Canadian company called Teck, BHP's had another crack at Anglo, and again been rejected quite brutally. So what it says to me is, we've got a question today about iron ore, but what it says to me is that BHP is very keen to become a copper-led company rather than an iron ore-led company. And
Right.
the Anglo deal would have helped that. Hasn't worked out, but you can see the direction of travel here pretty clearly.
Okay, now before we get to questions, let's have a quick word from our sponsor.
The market never sits still, so staying ahead of the curve matters. Intelligent Investor Premium helps you invest smarter without spending hours on research. You'll get buy, hold and sell recommendations on more than 80 Australian and international stocks, special reports on big investment themes, market insights, interviews and Alan Kohler's popular weekend briefing. The best part? You can try Intelligent Investor Premium for free for 15 days, even if you've tried it before, and you don't need to provide any credit card details. Just visit intelligentinvestor.com.au.
Okay, first question from John from Brunswick. Alan wrote a column this week about humanoid robots taking all our jobs and tossing up some scenarios that might ensue. My question is more fundamental. Why humanoid robots? What's the point of trying to replicate human movement? Surely if we want to advance society, we'd make something more efficient that eliminated all the choke points in human anatomy. Or do we want ones that make old man noises when they get out of the reading chair? Very funny. We're certainly heading for C3PO rather than R2D2 don't you think? I mean,
Yeah.
that's clearly the case. And the reason, John, simply is that the world is built for the human anatomy. For robots or creatures that are roughly the size of human beings, with 2 arms, 2 legs, and hands that pick things up and opposable thumbs. I mean, that's what the world is built for, and that's why the companies are doing it. And the other reason is that they think, probably rightly, that robots that look human will be more comfortable for people. That'll be, and they'll be able to sell them as companions. I mean, some of the robots, if you look on YouTube, you'll see that some of the robots have very beautiful female faces.
There you go. Well, I think the answer to John's question is actually in his question. Humanoid robots would mean he doesn't need to get out of the reading chair. They could just go and do his stuff for him. So that's the point, isn't it?
Yeah, that's right. I mean, they need to, in order to do the dishes, they need to be high enough to reach into the sink or reach the cupboards to put the stuff away. I mean, so it's kind of our houses are built for human anatomy.
Yeah. Gary's got a very long question, but he's
you can summarise it.
What he says is he's calling it artificial ignorance, not artificial intelligence, and the bubble will burst. He's making the point that AI is going to have lots of amazing benefits across the industry. But the problem is he's finding in his searches, and I think a lot of people would agree, it just gets things wrong. Simple things that are the answers to which are pretty obvious, including, can I use my credit card on my Apple Watch in India? Well, the ChatGPT told Gary no, he couldn't use his Apple Watch and credit card in India. He went to India, and guess what? He could. So this is his point. The AI produces some nonsense, misses basic facts, and that will be the downfall of the AI bubble, because people will just stop. People don't believe or don't trust the AI to do the tasks that it says it can. Alan, what do you make of that?
I think the point he's missing is that this is just the beginning. I mean, we've barely begun this process of transitioning to AI and being basically dominated by it. So I think, there's probably some flaws now, but they won't last.
Yeah, it's that old saying, AI is as crappy today as it's ever going to be. It's only getting better from here. But yeah. I actually think, I still think Gary's right. I mean, bubbles tend to be, what you're talking about, Alan, is the rise of AI over decades. Perhaps what Gary's talking about, to verbal him a bit, is the potential for AI bubble to burst in the next 3 years as its short-term usefulness is.
Oh, well, of course that's true. I mean, the AI, the price bubble of the stocks will clearly, obviously burst. I mean, but that's kind of in a sense that's neither here nor there in the scheme of things.
Yeah.
We're still going to have AI, and we're still going to have humanoid robots. The price will go up and down.
Not doing this podcast though.
Well, we hope not. No, that's right. Okay, Alex says, I read an interesting article in the FT talking about big insurers increasingly excluding AI from their corporate insurance policies. And he goes on to say whether, insurance industry was the sleeping giant in the climate transition. Have we just been assuming that all companies will be able to get liability insurance when they do AI? I think that's an interesting point. I hadn't really thought of that. And I think AI could be a challenge. But again, maybe it's an issue about being the early days in AI, and insurance companies need to become comfortable with it, which will take a while.
Yeah, perhaps. I mean, I think there's some really interesting ideas. Like one of the industries that a lot of our listeners would be familiar with is like financial planning or financial advice. Now, to be a financial planner, there's obviously a lot of qualifications involved, lots of legalistic disclosure documents and all that. But when you go onto ChatGPT and ask me how should I approach this financial problem in my life, it spits out a whole lot of answers. Now, I tested this the other day. It does say I'm not a registered financial advisor or tax advisor, so take my answer with a grain of salt. But how many people are going to look at that? How long is it before we get a complaint to AFCA or something like that? I followed the AI advice and it stuffed my life up, or I lost money. Who will be to blame for that? Who would you bring that claim against?
Yeah, well,
it's just an interesting regulatory question that goes to this in sort of broader. The insurance problem is who's responsible. I think that's the same question regulators are asking themselves.
I suppose if somebody bases their investment decisions on an AI that tells you it's not a registered financial advisor, then the person responsible is the person that's his or herself. I mean, the reason you can go a financial advisor if they give you poor advice is because they are registered.
Yes, but I guess my point would be we have seen the ACCC and others take action against social media platforms, for example, for allowing deep fakes and irresponsible advertising. Is there a similarity there? I reckon there probably is.
It'll be interesting to see who's responsible if a driverless car runs someone over. I mean,
yeah, totally.
I mean, I suppose that's a common question, isn't it?
Yeah. Lockie says, James Thomson is very bearish on Australian iron ore. Are his criticisms fair? Even if China's demand plateaus, wouldn't Australia's proximity to Indonesia, India and Africa support long-term demands? Are these emerging economies likely to industrialise in a similar way to China over the next 20 years? Could there be another iron ore boom? No, Lockie. We will not see a similar level of demand. Definitely not from Indonesia and Africa, because there's plenty of iron ore in Africa, including the giant new Simandou project, so they won't need our iron ore. India is a possibility. We're seeing some demand there, but it's nothing like the Chinese boom. And so we are unlikely to see an industrialization project like that in China. So that's... And the other thing is we'll see increased use of recycled iron ore, which will mean you need less of the new stuff out of the ground. So, look, iron ore is going to be a great contributor to the Australian economy for many years. But look at what don't believe me. Look at what BHP is trying to do as it tries to buy Anglo American and turn itself in from an iron ore-led company into a copper-led company. They are telling you what is happening.
And the other problem, as I understand it, and this is, I'm not an expert, so take this as with a grain of salt, but we're clearly going to have to move towards what's called green iron and steel, which is to say made without emitting lots of carbon dioxide. And as I understand it, Australia's iron ore is not well suited to that.
It is not perfect. Not perfect.
Yeah.
There can be technological changes. The miners are pretty confident of that. But yeah, that's an issue too.
Jonathan says, saving for a house deposit becoming increasingly difficult. Saving for a cash deposit becomes with risk, as the rate of return will never match the appreciation of house values. So savers need a means to ensure that the deposit appreciates in line with the home they want to buy. So shares and ETFs come with the risk that you mightn't get there. So maybe, he says, what about a housing ETF that you can invest in your deposit so that your deposit grows at the same rate as the house prices? Well, yeah, I guess. I mean, look, there aren't any. There's been a few attempts to do this and never really worked.
No.
And anyway, the whole project, the national project that the government's leading, is to stop house price appreciation continuing at the same level it has been. I mean, they're trying to. So they are definitely, the government is definitely trying to make sure housing is not as good an investment as it's been in the past. So I think you'd be better off sticking with shares, to be honest.
Yeah. I think there's some complexities to that, but I keep coming back to your point that you make frequently, Alan. We don't want housing to be a good investment. That's not the way we're going to get this crisis solved. So,
yeah, and you can make an argument that it's not going to work. That the government's not going to pull this off, but they are trying. So really, it's if you invest in housing now, you're taking a risk, I think, for sure.
Well, it's not stopping people. The investment market's going crazy at the moment. Jimmy in Hawthorne says, hi, legends. His question is about the impact of house prices and rent on living standards. Median house prices in Melbourne are currently $700,000 less than in Sydney. Median rent in Melbourne's also about $200 a week less. As far as I can see, other costs of living and income aren't vastly different between the two cities. What impact does this difference in house and rental prices have on how people in these cities are currently living and spending? i.e., do Melburnians have more expendable income, and what do they spend it on compared to Sydney-siders? Interesting question, Alan.
Yeah, I do think there is a difference in incomes. I'm just trying to remember now. I did a comparison. I think it was CoreLogic or AMP, either one, did a survey where they looked at the house price to income ratio in each capital city, and the most expensive capital city was not Sydney but Adelaide by far, because the incomes in Adelaide are lower.
Gotcha.
And I don't. So I'm just trying to think of Melbourne versus Sydney, and it wasn't what you think.
Yeah, there is a disparity, I think, in living costs between Melbourne and Sydney. And the reason I say that is not because of the Allen Kohler, but because of the Kohler that the AFL used to have, the cost of living allowance, which helped players moving to Sydney defray their higher living expenses. Oh, no, it was very controversial, the Kohler, but
yeah,
I think there is a bit of a disparity that probably explains a bit of that.
Yeah, and there is a disparity in incomes too.
Yeah,
I think.
So, Jimmy, I don't think Melburnians are living it up compared to their Sydney-sider friends.
Grant says, thanks for the podcast. Hypothetically speaking, given the current stock market is at all-time highs, if you were 50 years old, already retired, and had $3 million in cash and no other investments, how would you deploy it today? I recognise this is not personal advice, but purely a hypothetical question. So I don't know whether Grant is 50 years old, already retired, and got $3 million in the bank or not. But anyway, if you have, Grant, congratulations. Good on you.
Yes, and my advice, Grant, and this is personal advice, is to go and buy as much wine as you can and enjoy the next 40 years of your life. No, I don't, that's not responsible, is it?
No.
I'm not sure. Look, $3 million in cash and no other investments. I think you'd be looking to put. I don't know. You'd be looking to get some sort of market exposure. You'd be trying to do what a super fund does, really, wouldn't you? You still, a Grant, or the hypothetical Grant might seriously still have 40 years to live.
Yeah, of course. And for that reason, I think I think the market looks expensive at the moment. I mean, who knows when and how much the AI bubble will deflate, and what effect that'll have on the Australian share market. It's impossible to know. I mean, the 2000 crash in the US affected the Australian market, but not that much. But really, we just don't know, and we don't know the extent to which the banks are overpriced and will fall, which is kind of 20% of our market. And the mining companies, what's the iron ore situation? Is James right that the iron ore situation is going to be difficult? So look, it's hard. So I reckon given all those things, term deposits look pretty good, I've got to say. I mean,
okay,
term deposits for perhaps half or 2/3 of the money. Why not?
Yeah. But I mean, I think that's my point about trying to mimic what a super fund does. You some exposure to cash, some exposure to stocks around the world. I think generally this isn't a time you want to have all your eggs in one basket. I wouldn't have thought.
Yeah.
All right, I'm going down to Josh's question. He says, I'm in my late 20s with a long-term investment horizon. I recently heard another reputable finance podcast. Is there other finance podcasts? Discussing the benefits of a moderately geared index ETF, around 30 to 40% gearing. There's a couple of examples. Beta Shares got GBL and Gear. Historically, I've always assumed that using leverage, especially as a retail investor, was one of the quickest ways to blow up your portfolio. So I was surprised to hear a more positive take on these things. He's done a little bit of research through Alan's friend Chad Jippity, which is ChatGPT. He simulated the last 20 years of returns using the MSCI World Index gains. A geared version, roughly 35% gearing, ended up about 17% ahead of an ungeared version, even with the expected deeper drawdowns, including the GFC, along the way. what's your perspective, especially for young investors navigating high housing costs and considering taking on controlled amounts of leverage elsewhere? That last point, Alan, from Josh, is really interesting, I reckon. If you're a young person thinking about getting into the housing market, you're thinking about taking on one of the most highly geared purchases in your life. Why should you be worried about a moderately geared investment in an ETF?
That's a good point. I mean, you can borrow, and people do borrow 80% of the value of a house, so you're geared sort of 5 times. Whereas shares, people just generally buy with cash and don't gear at all. So, you're right. There's a big difference in the approach there. Housing is seen as much less volatile, and it is much less volatile. Obviously, housing tends to fall by no more than 10% usually when it does fall.
Yeah.
The share market can fall 50%. So, look, you need to be careful because you do need, if you're going to invest in the share market, you do need to be able to withstand a 30 to 50% drawdown.
Which is magnified with gearing.
That's right. But it is true that over the long term, those kind of things do not matter as much, at least.
Again, not personal advice, Alan, but for a young person, is there an argument to say, okay, I'm not going to put all my eggs, I'm not going to put all my eggs in the geared basket, but perhaps a portion of your portfolio is exposed to some sort of geared process, and you treat it as as a small part of your allocation overall.
Yeah, and you're probably better off doing it through a geared ETF rather than take out margin loans yourself, because margin loans, when there's a big fall in the share market, you'll have to top up. You'll get a margin call, and you'll have to put cash in, which you don't want to do.
No, indeed. The one thing I'd warn people about at the moment, there are, particularly in America, a lot of single stocked geared ETFs. So you can bet with 5 times leverage on Nvidia, for example. Now that really magnifies the gains and the losses. I'd be very wary about single stock geared ETFs. That's very risky. That is eggs in one basket type stuff.
Yeah. Jamie, I'm a huge supporter of smart, skilled careers and manufacturing for Australia. This is why I was excited to see over 200 new engineering jobs at DroneShield. However, I'm shocked at the pile-on by journalists using short sellers who benefit from failure as evidence without a balanced counter-argument, such as record revenue recorded only months ago. And if things are bad, why wouldn't the CEO not sell out at double $6.60, or for better optics, sell half his holdings at that price? And thus, gosh, if the CEO is Captain Evil, give him some credit. He would have engineered his retirement, selling down much more conservatively. Otherwise, his personal assets become liable in a rushed escape. So a defender of Oleg there, Jamie. Fair enough.
And look, I mean, the DroneShield technology is exciting. The fact that, that DroneShield has created engineering jobs and advanced manufacturing jobs, again, really exciting. But I think, Jamie, it's worth remembering the timeline here. Basically, 1 week Oleg's options convert. The next few days, he sells his entire stake in the company. Now, if you think that's a sign of, if you think there's not investors out there thinking, oh my God, what does he know that we don't? You're nuts. That is the risk here. That ordinary investors look at this and think, hang on, has Oleg decided this is the peak? Is this the top? Is this as good as it gets? Why is he selling all of his shares? Why has he just sold every one of his common shares? That's the bit that's difficult for ordinary investors to understand, and that's why DroneShield stock is down, 70% in the last couple of months. It's got nothing to do, absolutely nothing to do with journalists and short sellers.
Also, from Jamie's point of view, it's actually great news if the stock's down 70%.
Yeah.
Because of a sort of a short-term and conflated governance issue, and basically the company's in fine shape, then it's a fantastic buy. And it's great news that the stock's down so much.
Yeah, and I think Stephen made the point last week. It's still up, substantially for the year. So
yeah, I mean, look, I've interviewed Oleg once a year for 6 years, and so I've in a sense travelled the journey with him, and I've always admired what he's done. I think he's done a fantastic job because he's stuck with it. It's been hard, really hard going. And it's finally, thanks to the Russian invasion of Ukraine, it's finally coming good for him. And I think that's great. But you're right. I mean, he's gone and sold. It's really a sign that he doesn't have faith in the company, or he thinks that the Sydney property market's going to do better than DroneShield, because that's what he's doing with the money. He seems to be buying a bloody house in Bondi.
We should say he did reconfirm his unwavering commitment to DroneShield this week, but it's a bit hollow when you've sold all your stock and you're just left with vested and unvested options.
One more question, do you think?
Another question, Josh. He's a long-time listener, first-time caller, and he wants a podcast with the two Kohlers, Chris and Alan. I agree, Josh. Get it happening. He's referring to an episode a couple of weeks ago called "Our Market Crashette." You touched on why you'd never go into politics, and I've got a bone to pick because you blokes tried to put me into politics. My concern is that almost everyone I can think of would make a great local, state or federal representative feels the same way. The media circus and the bureaucracy aren't worth it. So how do we fix that? What would it take for capable, values-driven people to actually put their hand up? Based on your equitable social and economic views, I'd vote for you, and I suspect many young Australians would too. I think this is for you, Alan. This is a vote one Alan Kohler. Or maybe Alan and Chris on a joint ticket.
Oh, well, I think you'd have to be mad to go into politics, but, I mean, I'd never...
But what do we do to change that, to get to Josh's point?
Well, I don't think you can. I mean, politicians use the media. It's not just the media that's doing it. The politicians are actually doing it. They are trying to first become well known, second, be approved of, and I mean, they're doing it. I mean, I tend to watch the news on the TV every night, and every night the Victorian Premier, Jacinta Allen, has got a hard hat on somewhere and doing a photo op every day. I mean, I don't know, is she doing any work? What's going on? So she's just all about the media. Like, I mean, she could easily stay in her office and work for a couple of days at a time and not head out with a hard hat on standing in the bloody street somewhere.
Yeah.
I mean, honestly, they could. So politicians could actually definitely stay out of the media if they wanted to, but they don't want to.
The other thing, I've had this theory for a little while that the great contrarian play in politics would be to agree with most of the things that your opponent says, because most of the time, we've got broadly centrist parties in Australia. Not all the time, I'd grant it, but broadly they're centrist. I wonder if the play is to say, yeah, that's fine. Here's where we disagree, and we really want to make a point of it, whether it's on housing policy or climate or whatever it is. But we're just going to take the sort of black versus white, no grey sting out of all this. I don't know.
I agree. I mean, the opposition seems to feel obliged to oppose everything.
Yes.
I know. And it's just like, that's rubbish. That's stupid, because a lot of things that both sides say is quite sensible. That's right.
Yeah. The last sort of, and I know it went off the rails thanks to Scott Morrison, but the last who appointed himself as treasurer and everything, or tried to. But the last sort of sensible moment we had of sort of bipartisan support was that there was COVID, ironically, wasn't it?
Yeah, that's
so
right.
We actually did have less of the oppositional politics that we're used to.
Yes.
I'm not sure you've convinced anyone to go into politics, though, I'm afraid, Josh. So, yeah.
Oh, no. No, not going to do that. All right. Okay. Well, that's great. Thanks very much, James. Great. Thanks, everyone, for listening to today's episode of Money Café. I'll be back next week with Stephen Mayne, and James will be back in a fortnight. Send in your question to themoneycafe@eurekareport.com.au. If your question didn't get answered today, please try again. We can't get through. We get so many questions, we can't possibly get through them all, but we always try. So until then, I'm Alan Kohler, founder of Eureka Report and a person on the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
See you soon.